Welcome back to Equity Mates Investing. We've just covered off everything that's been happening while I have been away and the latest book club. But Ren, to close out today, you went and spent time at JPMorgan HQ while I was away as well and got their latest quarterly update on where they see markets. What are the big topics that were covered?
Yeah, so four high-level topics, I think. The recent market crash.
Yeah.
The broader economy and where it's at. What next for interest rates?
Nice.
And then what's an investor to do amongst it all?
Okay.
So starting with the recent market crash, the big headline quote, you should be thinking opportunity, not fear.
Great.
Yeah. And their reasoning there was when prices fall like they have without any meaningful change to the macro or the micro environment, it spells opportunity.
Okay.
You know, like nothing materially changed. It was just a bit of a weak jobs report and a bit of nervousness about a recession. But we kind of knew the recession was on the cards anyway.
Yes. Yeah.
They also think that sell-off was amplified by quants and trend-following models where models said sell even if the fundamentals didn't.
Yeah.
Another quote that I wrote down, the sell-off was a function of uneconomic sellers of their positions.
All right.
You know, so people that are just like following the models.
Yeah. Oh,
So
that's good to know.
That's number one. Number two, the broader economy. Struggling, but their most likely scenario remains a soft landing.
Okay.
Yeah. So they had some data. US jobs, unemployment, and job openings are just returning to pre-COVID 2019 levels. There's no doubt the consumer is feeling the pinch. This is US data, but credit card delinquencies are up and personal interest payments, ex-mortgages are also up. So recession is likely, if not already here. But inflation in the US is coming down. Personal consumption expenditure, which is the US's preferred measure of inflation, is at 2.5%. They think as growth slows, it'll hit the 2% target.
Nice.
So that's sort of like, are they threading the needle on the soft landing? Handbraking the economy enough to get inflation under control without tanking the economy.
Nice. Well, now the commentary will be, they haven't gone hard enough on cutting interest rates.
Yeah. Anyway, well, let's talk rates.
Let's talk. Perfect.
So rates. JP's view across the world, like in Australia as well, is the next move is down.
Okay.
So it's just a question of timing. So they agree with the RBA projection that there'll be no rate cuts for the next 6 months in Australia, but then they think it'll be next move down early next year.
Okay.
Yeah.
Wow.
For the US, they think a cut in September. The only question is whether it's 25 or 50 basis points. In total, they think 150 basis points will be cut. So that would take the current range of 5.25% to 5.5% down to 3.75 to 4.
Nice.
Yeah. So they're like their big economic forecasts and takeaways. The question then is, what's an investor to do? And they noted that there's a lot of data showing that a lot of investors are moving to cash.
They are?
Are moving to cash. Total investments in money market funds, which is essentially like a cash investment, you get a return on your cash, reached $6 trillion in the US. But JP warned about having too much cash. The numbers, 200 grand in a money market fund or a high interest savings account, call it 4.5% interest for 30 years, gets you 800 grand. Not bad.
Not bad, yeah.
But 200 grand in the stock market at the average return for 30 years gets you over $3 million.
Wow.
Yeah.
Wow.
And they asked the question, which I think is a good question. What do you think is more likely? The stock market average return continues, that average continues, or the savings rate stays at 4.5%?
You've got to go with the stock market.
Yeah.
Yeah.
A note on the correlation between stocks and bonds. For the last 25 years, they said that there was a negative correlation. So they moved in an inverse way to each other. But that correlation has broken. They think a lot of the economic textbooks are wrong.
Oh, wow.
They've just been written in the last 25 years. And if you zoom out further in history, you'll see that stocks and bonds generally are positively correlated.
All right.
If you're a big bond trader, I haven't
No.
fact-checked it. But I thought it was interesting. And then one other thing for investors, dividend investing, they've noticed is like a big focus for a lot of people, income investing. But they made the point that you need to like every stock you own. Never own a stock you don't like just for the dividend yield.
Love that.
Yeah.
Yeah.
So I think that's a good reminder. And then a final note on what's coming next. The US elections coming up.
Yes.
They looked at data back to 1990. So that's 8 US elections.
Yeah.
Stocks decline pre-election and then rally post-election.
Regardless of result.
The only 2 times they haven't rallied post-election, 2000, which was then getting into the tech bubble bursting, and 2008, when we were in the teeth of the global financial crisis. So all 6 other times since Clinton was elected in 1992, decline pre-election, rally post-election.
Nice. That is one thing that I did keep an eye on while I was overseas, what's playing out in the US at the moment. It's just fascinating.
What are your thoughts?
Oh, I'm just so stoked that Biden handed the baton over.
100%.
Like, oh my God, thank goodness. I think the VP pick that she's done as well Tim Walz. Yeah, love that guy.
Yeah.
And I'm just loving seeing the Republicans and Trump squirm, feel uncomfortable now. Anyway, not to make it political,
we're not going to get political.
I did enjoy, well, I am enjoying seeing that. So much so that I've actually returned to watching some House of Cards. Because I was just like, I watched that at a time at uni where I probably knew less about the actual US politics and like the structure of it all and everything. And now I've got a much better understanding of it. So started going back and watching some of that. Appreciating it a bit more.
Nice.
Equity line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.